welcome grade 11 accounting students. Yes, guys, it's that time of the year again where you are busy preparing for your June exams, and I'm here today to help you to do just that. So together, hopefully, we're going to work together and help you master certain topics in accounting. Now, in today's lesson, our focus will be on analysis and interpretation of financial information for a partnership. So you guys know exactly what I'm talking about. Yes, there's going to be ratio calculation, interpretation, and obviously comments in terms of what we are interpreting. Okay, right, so remember guys, as usual, I'm going to remind you to have some pen, paper, very important to have your calculators in front of you. Let's start, let's work together. Right, now the information that we are given, or the question that we're given, use the information of NZ traders with partners, Zuleika and Nadia, to answer the questions given. The business's financial year ends on the 30th of June. So let's now look at the information in front of us. Right, so the information was extracted from the financial statements on the 30th of June. So in other words, they're not giving us the entire income statement and balance sheet, but they're giving us an extract of the financials. Right, we are given, as usual, 2016 current year, as well as 2015, which is our previous year. Now, very important, guys, at the start of your exam, 2015, remind yourself that this is your previous financial year, whereas 2016 will be your current financial year. Okay, make sure you don't confuse the two. Okay, right, so I'm given an extract, and if we look further down, okay, I notice immediately there's some missing information. Okay, so that's my extract. And then I've got some financial indicators. In other words, some ratios already calculated for me. So the ratios that they have calculated, the current ratio for the previous year is given. I've got the debt equity ratio for both years, solvency ratio only for the current year, the previous year, and then I've got the return on total capital employed given to me for 2 years. Okay, right, that's the information I have in front of me. Now let's quickly look at the questions that we are required to complete. Right, so as you can see, quite a number of questions. When I go to the answer sheet in a moment, you're going to see the questions in more detail. But just to give you heads up, what I've done is often I find during these lessons, we have the easy questions in the beginning and the more difficult, more challenging ones towards the end. So what I've done is I've changed the order of the questions. So I want you guys to just bear with me. It's not a mistake. I have changed the order of the questions so we can start with the more challenging questions. Okay, right, so let's look at our answer sheet and let's get started. Right, guys, our first question wants us to do the following. So I'm actually starting with 1.5, and the question reads, the partners are keen on expanding their business activities. In other words, they want their business to grow. They will need to borrow additional capital to finance the expansion. The first question, will the business be able to obtain an additional loan of 180,000? So in other words, yes or no. And then motivate your answer by quoting a relevant ratio. Okay, right, now remember guys, in this question, you're obviously given a scenario. The partners want to expand their business, and often, if you want to expand, you need capital. Obviously, if the partners cannot contribute the capital on their own, the capital needs to come from somewhere. So often, the partners will then borrow capital from the bank. So the question is asking us, will the business be able to secure an additional loan? Make sure you understand the question before you actually answer. Okay, right, so what information do we now need to look at in order for us to establish whether or not the business can secure this loan? So let's go to our information and let's look for something that's going to indicate whether or not the business can borrow more loan or take out an additional loan. Right, so our information. Okay, there we go. Right, so in terms of the financial indicators that have been given to us, okay, guys, I'm going to now look at my debt equity ratio. Now, in terms of my debt equity ratio, if I compare 2015 to 2016, 2015, the business's debt equity ratio was 0.17:1. 2016, this ratio has improved because remember, the lower this ratio, the better it is in terms of risk. So this ratio has improved or decreased to 0.07:1. So clearly indicating that this business is considered to be low geared or low risk. Okay, you guys with me? So in other words, the banks will definitely grant the business an additional loan, bearing in mind that they are low risk and low geared. Okay, right, so let's go to our answer sheet and let's quote this particular ratio. Okay, so in our answer booklet, okay, so we are looking at our debt equity ratio is 0.07:1. Okay, this indicates that the business is low risk. So the banks don't regard the business as a risk. They will easily grant the business an additional loan. Or you can also mention the business is low geared. Okay, now what do we mean by low geared? The business doesn't rely that much on borrowed capital, because if I had to read this ratio, for every 1 rand, okay, this should be a 1, guys, looks like an L, but it's actually a 1. For every 1 rand of own capital, the business relies on 7 cents of borrowed capital. In other words, they are low geared. Right, now based on this, the business will definitely qualify for an additional loan. Remember, often students like to double check, or sometimes the question will ask you to also show an additional calculation. So in other words, even after taking out an additional loan, so if the business does take out an additional loan of 180,000, we need to check whether the business will be low risk. So if we have to look at this calculation after taking out the additional loan, let's just go back to our information, okay? Right, so if we go to 2016, okay, guys? And if we now look at our non-current liability, it's currently at 20,000. So if the business took out the additional 180,000, this figure would change to 200,000. 180,000 plus the 20,000 to give me 200,000. And if we now examine our equity, remember this makes up your equity, immediately we can see, regardless of this being a debit balance, but if we see your capital, immediately we can see the capital is above 200,000. So clearly this ratio will still be below 1:1. In other words, the business would still qualify for an additional loan and still maintain being low geared or low risk. Okay, you guys got that? Right, so for the first question, we can actually conclude that the answer for that question will be yes. Okay, so in other words, yes, right, the business will be able to obtain an additional loan. You guys with me? Right, let's move on now to our next question. The next question, continuing with 1.5, the partners are keen on expanding their business activities. We know that already. They will need to borrow additional capital to finance the expansion. We've read that as well. Briefly explain whether or not it would be advisable to borrow capital. Motivate your answer by quoting a relevant ratio. Okay, now what I want to do is I want you guys to look at this question, and then I'm going to put up the information, and I'm going to give you guys 2 minutes to think about this. So if you are a bit confused, maybe chat to the person sitting next to you, and let's see what you guys come up with. How are you going to go about answering this question? Okay, so 2 minutes, guys. Your time starts now. Okay, guys, let's see what you were able to come up with. So one more time, briefly explain whether or not it would be advisable to borrow capital. Motivate your answer by quoting a relevant ratio. Right, now from the previous question, we could see that the business will be able to obtain an additional loan. So this question, what is this question wanting us to do or answer? This question is asking us to look at our financial indicators and for us to justify whether or not is it advisable for the business to borrow more capital. Now remember, guys, earlier on I explained a business borrows capital in order to expand. Now, why do they want to expand? Absolutely correct, because they want to increase their profits. But remember, when you borrow capital, there's a cost, there's an interest expense involved. You've got to pay interest. So this ratio that we are going to be looking at in detail tells us whether it is worthwhile borrowing the capital, and obviously taking into account we've got to pay interest. Okay, you guys with me? Right, so which ratio are we looking at? Which ratio am I talking about? Absolutely right, guys. Return on total capital employed. So let's go to our information sheet and let's see what this ratio is telling us. Right, now return on total capital employed. Remember, this is a ratio that you can abbreviate in the exam. Okay, we've got a return of 23% in 2015. 2016, there's a return of 32%. So clearly, an increase in profits, an increase in return. And then, very, very important, we need to now examine or compare this return to the interest that we are paying. So remember, guys, the return is 32% when using the bank's money, the partner's money, or capital contributions. And if we examine the interest rate that the business is paying interest at, it's currently sitting at 14%. Okay, so clearly, guys, your return, 32%, is far greater than your interest rate of 14%. And we can already see that from last year to this year, there is growth in terms of your profit, your return. Okay, now remember guys, when your return is higher than your interest rate, this indicates the business is positively geared. Okay, so in other words, taking out the loan is to the business's advantage because they are able to use the bank's money and generate large profits to cover the interest and to obviously grow the business. Okay, right, hopefully that makes sense. So let's now write this down, or let's quote all of this in our answer booklet. Right, so we've got the following. Okay, our return on total capital employed has improved, okay, from 2015, in brackets, quote the ratio, I'll do that in a moment, to 2016. So in brackets, our ratio in 2016, we're obviously quoting. Okay, right. The return on total capital employed is much higher or significantly higher. Let's go down. Than the interest rate of 14%. Okay, so in other words, it is to the business's advantage to borrow more capital. So in other words, is it advisable to borrow more capital? Yes, because this indicates positive gearing. Okay, now remember guys, if I go back to the information sheet, I can slot my return on total capital employed. Right guys, it's time for us to take a quick ad break, and when you come back, we will continue with this question. See you guys in a bit. Welcome back, grade 11s. Right, before the break, we discussed loans and whether it was advisable for the business to take out an additional loan or not. We also looked at whether a business will qualify for an additional loan. Okay, absolutely important, the two ratios that I've discussed. And please guys, please keep on practicing, because you're going to find that this will not only help you this year, but next year as well. Okay. Right, let's move on to our next question. 1.6, calculate Zuleika's total earnings for the year ended 30th of June 2016. You may use a ledger account as part of your calculation. Right, so that's obviously helping us because it's giving us a hint that if we reconstruct a ledger account, we will be able to calculate the total earnings by this particular partner. Right guys, which ledger account am I talking about? We've revised this last week and hopefully you remember. Okay, correct. If you did guess, or if you did shout out this answer, we are looking at your current account. Right, now remember, the current account is obviously for partner Zuleika. Right, let's now look at our information sheet so that we can fill in the figures for this account, and total earnings will then become our balancing figure. We've done this before, so this is now additional practice for you. Okay, so on my information sheet, I need an opening balance at the beginning of the year. So let's find that. So let's just go to our financial statements. And we've got current account for partner Zuleika. So at the beginning of the year, remember 2015 is the end of the previous year, or the opening balance for the current year. So my opening balance, 5,820, and it's a credit opening balance. So let's bring that balance down. Okay, so in my answer book, 5,820. Okay, and this is obviously my opening balance brought down. Right, once I've brought down my opening balance, remember guys, your salary, interest, share of remaining profit that makes up your total earnings. So your total earnings always is shown on the credit side. So in this case, total earnings is what we're trying to calculate. So that's going to be my unknown figure. So let that be equal to X, or whichever letter of the alphabet you like. But in this case, X, it's the unknown figure. Right, what do I show on the debit side? The debit side of the current account indicates whatever the partners have taken thus far from the business. So in other words, your drawings for the year. Right, now my drawings, obviously for partner Zuleika. So let's go back to our information and let's look for the drawings that she's taken for the year. So drawings, partner Zuleika, an amount of 50,600. So let's slot that into our answer sheet. Okay, 50,600. Just fix that. Okay, 50,600. Right, so I filled in my opening balance, I filled in drawings. So remember, reconstructing, you're obviously creating this account to calculate a missing figure. It's part of your calculations. So this account would obviously then be balanced at the end of the year. We have no idea what our totals are on either side, but we do have a closing balance that was given to us. So if we go back to our information, at the end of the current financial year, partner Zuleika's closing balance is 2,490, and it's a credit balance. Okay, so let's bring that through. 2,490 in our answer sheet. It's a credit balance, 2,490. Okay, can you see, guys, what I'm doing? I am reconstructing the account. Right, now if I've got balance brought down as accounting students on the credit side, then obviously, guys, carried down appears on the debit side. Okay, so on the debit side, I would have my 2,490. Now, why do I need brought down and carried down? Okay, remember, guys, we are trying to calculate a missing figure. So if we have brought down and carried down, this means that the debit side is equal to the credit side. So if I want to calculate my unknown, my X, I'm going to now add or total my debit side and then minus whatever I've got on the credit side. So I'm going to say that one more time. In order for me to calculate my unknown, I am adding whatever I've got on the debit side minus the figure on the credit side, and that's going to give me my X. Okay, so let's do that. X is equal to 50,600. We're now adding 2,490, and we're obviously subtracting 5,820, and that gives us, let's take the calculator out. Okay, so we've got 50,600, and then we're adding 2,490, and then minus 5,820, and that gives us total earnings 47,270. So that is my missing figure. Okay, right, so I've now calculated total earnings with the help of a ledger account. Now, you would have noticed while drawing up this ledger account, I didn't pay much detail or attention to details. Okay, the contra accounts, the details, not really worried about that, because remember, the question is telling me calculate a figure. Okay, it's not telling me draw the current account. Okay, there's a big difference between the two. It's also telling me you may draw a ledger account as part of your calculation. Okay, so even though I've used the ledger account, I've used it purely for calculation purposes. Hence, the details are not completely as accurate as when I draw a proper ledger account. Okay, I want you guys to remember that. Right, so we've done our current account and we've calculated our total earnings. Let's now move on to our next question. Okay, 1.7, guys, wants you to calculate partner Zuleika's percentage earnings on average equity. Should she be satisfied with this? explain. Okay, so in other words, remember, when partners invest in a business, they obviously expect to earn sufficient profits to earn a decent return on their investment. Okay, so that's exactly what this ratio is going to help us identify. Firstly, we're going to calculate what is her percentage return. Okay, so that's the first calculation that we're going to do. What is the percentage return or the percentage earnings by partner Zuleika? And then we're going to comment on whether or not she will be satisfied with this. Okay, right, so what I'm going to do is I'm going to put up the formula for you guys, and then I'm going to go back to the information sheet, give you guys maybe a minute, maybe two, let's see how it goes, and I want you guys to do this calculation for me. So how do I do this calculation? I'm going to take my total earnings from the previous question, and I'm now going to divide this by average owner's equity partner Zuleika. So in other words, half of her capital for 2 years plus her current account balances, so current account also for 2 years. Okay, so remember, 2 years, obviously 2016 plus 2015. Right, we're then going to multiply whatever answer we get by 100 because we want our answer to be a percentage. So that's my ratio, or that's my formula, and I'm now going to go to the information sheet so that you can calculate the ratio. Okay, guys. Okay, so let's give you 2 minutes to do this calculation. Your time starts now. Okay, guys, right, time's up. Let's see what percentage return you were able to calculate. Okay, total earnings, as I mentioned, it's coming from the previous question. So your total earnings, okay, remember I did change the screen for you guys to see the total earnings, 47,270. So let's take that through. Okay, 47,270. And we're now going to divide this by half of capital for both years plus the current account also for both years. So let's do that. Let's go to the information sheet. Right, so on our information sheet, remember we are looking at partner Zuleika. Okay, so there's her capital and there's her current account. So let's do the average owner's equity that she has contributed to this business. Right, so we've got her capital 180,000 plus 180,000. Okay, then plus current account, her balance 2,490. Remember, both are credit balances, so I'm adding plus, fix that, so plus 5,820. Okay, right, we're now going to divide this by 2 because we want an average. So her average equity 184,155. So let's fill that into our answer sheet. 184,155. So we've got 184,155. And remember, we're going to obviously multiply this in the end by 100. Right, so let's get the calculator out one more time. Let's clear that. So total earnings 47,270. And we're now dividing this by 184,155. Okay, and that gives us, okay, let's multiply that by 100. And that gives us 25,7%. If I round off to 1 decimal, so let's do that, 25,7%. Okay, so that is her total earnings. Right, now should she be satisfied with this? How are we going to go about answering this part of the question? Now remember guys, when a partner invests their capital or their funds into a business in the form of capital, obviously they're taking a high risk. Now, when you take a high risk, what does it mean by a high risk? You're not certain or you're not guaranteed of a return, because remember, we're obviously living in an environment where there is a bit of instability at times. So you're not sure whether your business is going to be successful or not. So because of the high risk involved, you obviously take that risk because you know if you're going to hit jackpot, that return is going to be high as well. Now, what are the alternatives to investing in a business? You could play it on the safe side and decide, let me take my money and invest it in a fixed deposit. But what's the disadvantage of that? The disadvantage is it's low risk, therefore the return, the interest, remember, that's the return. The interest that you're getting out of investing in a fixed deposit is quite low compared to opening a business. So this is what we compare the return to, alternate investment. Right, now I often tell my students, when we talk about alternate investment, we're obviously referring to, for example, a fixed deposit. And remember, when banks give you interest, obviously they take prime into consideration, and banks obviously give you less than prime because they have to make a profit. So bearing that in mind, if we now need to comment on this, okay, our comment would be as follows. The answer is, should she be satisfied? And the answer is yes, because the return of 25,7% is much higher. Okay, so it's much higher than alternate investment. Okay, you guys can write this out properly. So it's much higher than alternate investment. For example, a fixed deposit. Because remember guys, prime, what is prime at the moment? 10.5%. Banks will obviously give you less than prime. So we can clearly see that the 25,7% is much higher than the interest you would earn in a fixed deposit. Okay, another very important question, and hopefully you guys are making notes, you're listening, you're paying attention. I think it's time for another break. So I don't know, grab something to eat if your teacher allows you, and then we're going to carry on straight after the break. See you guys in a bit. Okay, welcome back guys. Let's carry on. We don't have much time, but let's see how much we can do in this last session. 1.8, partner Zuleika is unhappy about the amount partner Nadia has withdrawn during the year. Okay, so partner Zuleika is not happy. All right, let's see why. Calculate partner Nadia's drawings for the year and comment on whether Zuleika has a reason to be unhappy. Okay, so the question wants us to calculate firstly partner Nadia, how much she's taken out of the business, what is her drawings for the year, and then we're going to comment on why partner Zuleika is unhappy about whatever Nadia has taken from the business. So once again, guys, I'm going to rely on a ledger account, and this time I'm reconstructing again the current account, but this time around it's for partner Nadia. Now remember, guys, your current account tells you, in a nutshell, we've been through this, your current account tells you what the partners are entitled to take as per their partnership agreement versus what they've already taken. Okay, so for example, I could be entitled to 1,000 Rand and I've taken 900 Rand. Okay, so in that case, I haven't taken everything that I'm entitled to. So in a way, that's kind of a good situation to be in. But if it's the opposite, so for example, I'm entitled to 1,000, but I've already taken 1,200. So clearly, I'm not following my partnership agreement, my partnership terms. So let's see if that is the situation in this case. Right, so partner Nadia, let's start with her opening balance for her current account. So back to our information sheet. So partner Nadia, immediately I can see a problem. So she's got a debit opening balance of 1,810. So let's bring that down. Okay, so in my answer book, on the debit side, 1,810. And remember, guys, this clearly indicates that in the previous financial year, she's taken more than what she was entitled to. You guys with me? Right, so I've brought down my opening balance. Now let's look at her total earnings that she's entitled to take for this financial year. So her total earnings, okay, I think we've given her total earnings. So partner Nadia, her total earnings, 27,110. So let's fill that in, 27,110. So 27,110. Right, now remember, the question wants us to calculate the drawings, what she has taken for this financial year. And once again, drawings is my unknown figure. So that's going to be my X. Right, the last bit of information that I need to fill in into this ledger account is now my balance at the end of the financial year. So once again, my information sheet is going to give me that. So my balance at the end of the year, current account Nadia, so she's got, once again, a debit balance of 4,500. So let's fill that in. Okay, so 4,500, a debit balance, 4,500. So clearly we can see why Zuleika is not happy, because she's again taken more than what she was entitled to. So remember, guys, I've explained this already. If brought down appears on the debit side, as accounting students, you know that carried down then appears on the opposite side, in other words, on the credit side. So 4,700. Right, so once again, if I've got my carried down, I've got my brought down, I've reconstructed my account, it means that the debit side is exactly the same, is equal to the credit side. So in order for me to calculate my unknown figure, all I'm doing is the following. So X is equal to, okay, so I'm going to take out my calculator because you should be familiar with this now. So I'm going to start on the credit side. So I've got 27,110, okay, plus 4,700, and then I'm going to subtract 1,810, and that gives me the total drawings, what she's taken, an amount of 30,000. Right, and once again, what can we see? If we compare what she's taken to what she was entitled to take, we can clearly see she's taking more than what she's entitled to. So she's obviously clearly not following her partnership agreement. Okay, right, so remember, guys, you would now write that down, that partner Nadia has debit balances. In other words, she's taken more than what she was entitled to. Okay, right, so I've finished, or I've completed most of the difficult questions. Now let's go back, or let's try and do certain questions that you should be much more comfortable with. So we're ending off with the easier questions. Right, the first one, calculate the current ratio for 2016. Make necessary comments on the above calculation. So your current ratio, we know, we are now comparing current assets to current liabilities. So let's go to our information sheet, 2016. Okay, so let's start with our current liability. So your current liability is sitting at 62,500. So let's fill that in. Okay, 62,500 is my current liability, 62,500. And my current assets, your current assets for 2016, 150,000. So there's my current assets. Let's fill that in. Okay, an amount of 150,000. So let's now convert this into a ratio. So as usual, the right-hand side must equal to 1. So in order for my left-hand side to be converted into a simplified ratio, so I'm going to take my current assets, which is 150,000, and I'm going to divide that by my current liabilities, 62,500, and that gives me a ratio of 2,4 is to 1. Okay. Right, they want me to comment, so let's do that. Let's comment. So remember, this represents 2016. So if I now go back to my information sheet, let's look at the ratio for 2015, the previous financial year. So in the previous financial year, our current ratio was sitting at 1,97. And remember, we just calculated this year, it's sitting at 2,4. So clearly, we can see that the current ratio has increased. I'm going to write the comments here, guys. The current ratio has increased from 1,97 to 2,4. Okay, now what does this mean? It means the business, based on only the current ratio, the business is able to pay its short-term debts. Straightforward. Okay, right, now let's move on to the next question, which is slightly more challenging than the question that we've just done. Okay, so back to our answer sheet. Let's now look at 1.3. And I'm hoping that you've seen this question before, because it's quite a popular question and requires you to work backwards. So where they're giving you the ratio and they're asking you to calculate something from the financial statement. So let's see exactly what they want us to calculate. Calculate the amount for inventory for 2016 if the asset test ratio for 2016 is 1,3 is to 1. Okay, so the question is asking us, what is your inventory for 2016 if the asset test ratio is 1,3 is to 1? Right, now we've just done the current ratio, and we know from our accounting knowledge that your current ratio always includes stock. So in terms of our current assets, and remember, this obviously includes stock, the figure for our current assets was 150,000. Now remember, guys, this is coming from your information sheet. So let's just quickly go there so you guys know exactly what I'm talking about. Current assets, 150,000. Okay, now remember, we compared this to our current liabilities earlier on. You guys remember that? Right, now let's go back to our answer book and let's look at how we're going to calculate stock. So our asset test ratio is 1,3 is to 1. So in other words, we know that in order for us to calculate this ratio, we obviously took current assets and we excluded stock. We subtracted stock. Okay, excluded your stock. The 150 includes stock asset test ratio, you are excluding your stock. So this amount, 1,3, represents this figure without trading stock. So how are we going to calculate that amount? Now remember guys, expressed as a ratio, 1,3 is to 1. And given the knowledge that we have, if we have to work backwards, the 1 represents your current liabilities, and your current liabilities for 2016, so let's just go back to the information sheet, it is 62,500. So let's use that information. Okay, 62,500. Right, now what does this ratio tell me? That if I'm working backwards to calculate current assets minus stock, that represents 1,3 times my current liabilities. Okay, remember when I read this ratio, for every 1 rand of current liabilities, we have current assets without stock, 1.30 rand. So in order for me to calculate this figure, my current assets without stock, watch what I'm doing. Okay, so I'm going to get my calculator out. So I'm using my current liability figure, 62,500, and I'm now multiplying this by 1.3. Okay, so that now gives me an amount of, I'm going to write it down here, 81,250. So in other words, this is my figure without stock. Okay, right, now I've got figure with stock, and now I have my figure without stock, my current assets without stock. So obviously, guys, the difference between these two figures gives me my stock value. Okay, so let's do that. Let's calculate your stock. So therefore, your trading stock figure will be as follows. Okay, let's get the calculator out. All right, my trading stock would be 150,000 minus 81,250, and therefore my stock figure, let's just write it in a different color pen. Go. Right, so my stock figure, so therefore stock is equal to 68,750. Okay, right, now you guys are probably thinking, wow, that was quite a long calculation. Isn't there an easier way to do this calculation? There actually is. There's a minute left, so let's see if I can quickly show you an easier way. Right, my current asset ratio was 2,4 is to 1, and my asset test ratio is 1,3 is to 1. So if I take my current ratio and I subtract my asset test ratio, let's do that quickly. So we're getting 2.4 minus 1.3. Let's fix that, 1.3. My stock figure is 1,1. So my stock figure is 1,1 for every 1 rand of current liabilities. So again, 1,1, if I now multiply this by my stock, my current liability figure, 62,500, that gives me, there we go, the same figure, 68,750. Much shorter, much quicker, as long as you've understood what I've just done. If you haven't, don't panic. Hopefully we get another opportunity to do this, or you can always ask a friend, or you can ask your teacher. But remember, guys, the more you don't understand something, the sooner you need to try and figure this out and make sure that you understand. Okay, right, time's up. And I'm hoping that you guys have learned something today, that you're going to use this knowledge and you're going to go home and you're going to maybe redo an exercise on ratio analysis. Until I see you guys, or until we meet again, from me, it's good luck for the exams. God bless and goodbye.